What if I told you that everything you think you know about Bitcoin's price is a carefully constructed lie? Every headline screaming about retail mania, every story about meme fueled speculation, every billionaire's tweet that sends the market spinning, it's all part of an old story. A ghost story told to distract you from the truth of what's really happening right now. You've been sold the idea that Bitcoin is the people's currency, a decentralized rebellion against the financial establishment. You've seen the image of basement traders and crypto anarchists moving markets, a digital Wild West where anyone with a phone can get rich or lose it all. That was the story. And for a little while, it was even true. But the game has changed. The board has been redrawn, and the old players are getting shoved aside. The real power, the force that now dictates the violent swings of the world's most famous cryptocurrency, has shifted. It no longer lives in Reddit forums or Telegram channels. It's now wielded in the sterile boardrooms of Wall Street and the quiet halls of Congress. The story of retail hype isn't just outdated, it's a deliberate misdirection. It's a smokescreen to hide a quiet takeover. While the world was watching the drama of small-time traders, the giants of finance and politics were methodically seizing control. They aren't just participating in the Bitcoin market anymore. They are the market. And in this video, we're going to show you how they did it, why they're lying about it, and what it means for the future of Bitcoin. The story they're telling you is a fairy tale. It's time to talk about reality. To understand the lie, you first have to understand the original story. Because every great deception is built on a grain of truth. The legend of Bitcoin is a powerful one. It starts with an anonymous creator, Satoshi Nakamoto, dropping a new form of money on the world right in the smoldering ashes of the 2008 financial crisis. It was a cypherpunk dream come to life, a currency free from the clutches of corrupt banks and reckless governments. In the early days, this was reality. The first people to use Bitcoin were idealists, programmers, and libertarians. They mined it on home computers. They used it on dark web markets like the Silk Road. It was a subculture, a tech curiosity that was actively hostile to the mainstream. And this small, dedicated, and often weird community moved the price. Then came the 2017 boom. This is the chapter everyone remembers. It was the year Bitcoin exploded into the public's mind. The price shot up from under $1,000 to nearly $20,000, and who was driving it? Retail. It was a global frenzy of FOMO, fear of missing out. You heard stories everywhere of teachers, baristas, and grandparents pouring their savings into this digital gold rush. Google searches for how to buy Bitcoin went parabolic. Coinbase was crashing under the traffic. For that one insane period, the retail story was 100% true. The collective madness of millions of small investors was the single biggest force moving the price. And because that story was so dramatic, so simple, and so damn compelling, it stuck. The image of the emotional retail trader became synonymous with Bitcoin. When the price crashed in 2018, who got the blame? Retail panic sellers. When it started to climb again, who got the credit? A new wave of retail FOMO. The media, analysts, and even seasoned investors grabbed onto this simple explanation for everything. It just became the default. But here's the twist they don't talk about. The 2020 to 2021 cycle was different. On the surface, it looked the same. Prices soared, new investors piled in, there was plenty of hype. But underneath, a tectonic shift was happening. The whispers of institutional interest were growing louder. While headlines focused on Elon Musk's tweets and the GameStop chaos, something far more significant was happening in the background. The big money was starting to show up. So why is the old lie still being peddled? Why, in late 2025, are we still hearing this tired story about retail speculators driving the price? You have to ask yourself, who benefits from you believing that? First, the financial platforms and exchanges. Their business model is trading fees. By pushing the idea that the little guy can still move markets, they encourage you to trade constantly. They want you to feel like your trades matter because it keeps you on their platforms clicking buy and sell and making them money. Second, the institutions themselves. The giants of finance prefer to move in the shadows. The last thing they wanted was for everyone to see the true scale of their buying. By letting the media fixate on the noise of retail drama, they could quietly build massive positions without causing a panic that would drive up their own entry price. They hid their invasion behind the camouflage of market chaos, letting retail take the credit for the rallies and the blame for the crashes. It was the perfect cover. They were the shark moving silently beneath the waves, while everyone was distracted by the splashing at the surface. And finally, it gives everyone a convenient scapegoat. When the market tanks, it's easy to point the finger at weak-handed retail investors selling in a panic. It lets the big players off the hook and reinforces the idea that Bitcoin is just a volatile toy for amateurs, not a globally significant asset being systematically absorbed by the world's largest financial entities. The data shows this shift is undeniable. While retail investors still play a part, their influence has been dwarfed. Price moves are no longer driven by public hype, but by massive, calculated institutional flows. The old story is comfortable, it's familiar, and it's a lie. The age of retail dominance is over. It's time to meet the new bosses. If retail traders aren't in the driver's seat anymore, who is? The answer is simple and stark. The largest, most powerful financial institutions on Earth. The story of their takeover isn't about speculation. It's about systematic, methodical, and overwhelming accumulation. And it was unleashed by a single, devastatingly effective weapon, the Spot Bitcoin ETF. For years, a Spot Bitcoin ETF, a fund you can buy like a stock that holds real Bitcoin, was the industry's holy grail. It was proposed again and again and shot down every time by US regulators. But in January 2024, the dam finally broke. The SEC's approval wasn't just a news story, it was the shot heard round the financial world. It was the official green light for Wall Street to enter the game. And they didn't just enter, they stormed the field, fundamentally and permanently altering the market. To get the scale of this, you only need to look at one name: BlackRock. BlackRock isn't just another company. It is the largest asset manager in the world, a financial leviathan with trillions of dollars under its control. They don't follow trends, they create them. When BlackRock launched its iShares Bitcoin Trust, or IBIT, it was a declaration of intent. As of late 2025, IBIT holds around 800,000 Bitcoin, worth tens of billions of dollars. In less than 2 years, a single Bitcoin fund from a single company became one of the most successful ETF launches in history, and they're not alone. Fidelity's fund, FBTC, holds tens of billions in assets, and Grayscale, another giant, holds billions more. This isn't a niche product. It's a systemic embrace of Bitcoin by the heart of traditional finance. So how exactly does this move the price? This is the most important part. When you buy $100 of Bitcoin on an exchange, it's a simple trade. But when an institution or an individual buys a share of BlackRock's IBIT, something very different happens. BlackRock, as the fund, is legally obligated to go into the open market and buy the equivalent amount of real Bitcoin to back that share. This isn't speculation. This is one-way, relentless buying pressure. Every day as money flows into these ETFs, the fund managers become giant automated vacuum cleaners, sucking up any available Bitcoin they can find. This brings us to the second pillar of their dominance, the corporate treasury revolution. This movement was pioneered by one man, Michael Saylor of MicroStrategy. While other CEOs let their cash reserves get eaten by inflation, Saylor saw Bitcoin as a superior treasury reserve asset. He started converting his company's balance sheet into Bitcoin. People called him crazy. Today, he looks like a prophet. As of late 2025, MicroStrategy has become the largest corporate holder of Bitcoin in the world, amassing a trove of over 641,000 BTC. Now, a growing wave of other companies are following his lead, seeing Bitcoin as a hedge against currency debasement. Connect these two forces. On one side, you have ETFs hoovering up thousands of Bitcoin daily. On the other, you have corporations buying Bitcoin to lock away for years. The result, a historic supply squeeze. This Bitcoin isn't for a quick flip. It's being moved into deep cold storage, effectively vanishing from the tradable supply. Analysts call this illiquid supply, and data shows it has soared to a record high, with over 72% of all Bitcoin now held by entities that rarely sell. This means that out of nearly 20 million BTC mined, only an estimated 5.6 million are even available for active trading, and that number shrinks daily. This creates a fragile balance. When the available supply gets this thin, even small shifts in demand can trigger explosive price moves. It's Econ 101, but supercharged by billions of institutional dollars. A 2025 survey showed a majority of institutional investors plan to significantly increase their crypto allocations. This isn't a fad, it's a strategic global reallocation of capital. The institutions are no longer knocking on the door, they've kicked it down and are now rewriting the rules of the game. Look, this is a fundamental reshaping of an entire asset class happening in real time. The old rules are burning. If you want to stay ahead of these monumental shifts and understand the forces now at play, you need the right information. Make sure you're subscribed and have notifications turned on. We break down these unseen forces every week, so you're not left relying on old deceptive stories. And let me know in the comments. Before watching this, did you realize the scale of institutional control was this massive? I want to hear your thoughts. For a decade, the greatest fear in the crypto world was a government crackdown. The story was that politicians saw Bitcoin as a threat, a tool for criminals, a challenge to the dollar, an unstable casino. Every market crash was fueled by fears that the US government would try to ban or cripple it. But what if the real threat wasn't a ban? What if the real threat was an embrace? By mid 2025, that fear was turned completely on its head. The United States government didn't kill Bitcoin, it legitimized it. In a historic shift, the entire conversation in Washington changed from if to how crypto should be regulated. The enemy was no longer at the gates. They were inside, redesigning the castle to suit their needs. This pivot wasn't a single event, but a strategic change in direction. The first most obvious signal was the SEC's approval of the Spot Bitcoin ETFs in 2024, but the shift runs deeper. Bipartisan bills began emerging in Congress aimed at finally providing regulatory clarity, the one thing big institutions crave. For years, the biggest roadblock for Wall Street was ambiguity. Was Bitcoin a commodity, a security, property? The uncertainty created massive legal risks for any major firm. Proposed legislation aims to end the turf war between agencies like the SEC and CFTC by creating clear definitions, with many lawmakers pushing to give the CFTC, seen as more favorable to crypto, primary oversight of digital commodities like Bitcoin. This isn't a crackdown, it's an invitation. Regulatory uncertainty is poison to big money. Institutions thrive on clear rules. By providing that clarity, the US government is effectively sending a signal to every pension fund, insurance company, and Wall Street bank. It is now safe to proceed. This removes the so-called career risk for any fund manager who wants to allocate billions to Bitcoin. It's a formal endorsement from the most powerful government on earth. Simultaneously, there has been a strong push in Congress to limit the Federal Reserve's ability to issue a central bank digital currency, or a digital dollar. At first, this sounds like a win for privacy, but look closer. Why would a government so keen on financial control deliberately block its own state-controlled digital currency? The answer lies in who benefits. A US CBDC would directly compete with the private banking sector and the newly sanctioned, institutionally run crypto ecosystem. By blocking a public digital dollar, the government isn't just protecting citizen freedom, it's protecting the profit motives of its new partners in the financial industry. It ensures the future of digital money in America will be a privatized affair, run by the likes of BlackRock and Fidelity through their ETFs, not a public utility run by the Fed. This was a coordinated strategic pivot. The United States saw other regions moving ahead with crypto frameworks and realized it was at risk of being left behind. Regulation, once feared as Bitcoin's executioner, was weaponized into its ultimate enabler. It was the final piece of the puzzle needed to merge the disruptive power of crypto with the immense scale and stability of traditional finance. The political risk that hung over Bitcoin for a decade didn't just disappear, it flipped into a powerful tailwind, accelerating the very institutional takeover it was once supposed to prevent. Now, we pull all the threads together. We have the three great unseen forces now in command of Bitcoin's destiny. First, the institutional demand tsunami. Through spot ETFs and corporate treasuries, the world's largest pools of capital are engaged in a relentless, systematic accumulation of Bitcoin, draining the available supply from the market at a shocking rate. Second, the political green light. Through a massive shift in regulatory posture, the US government hasn't just legitimized Bitcoin, it's building a regulatory superhighway to help institutions pour in. And third, lurking in the code itself is the one force programmed into Bitcoin from day one, the halving. In April 2024, the Bitcoin network had its fourth halving, an event that automatically cut the creation of new coins in half. The reward for mining a new block dropped from 6.25 BTC to just 3.125 BTC. This is a pre-programmed, unchangeable supply shock. Every 4 years, it gets harder to make new Bitcoin. Historically, the biggest price impact of a halving isn't immediate. It tends to show up 12 to 18 months later as the full effect of the reduced supply collides with market demand. That timeline puts us squarely in late 2025 and heading into 2026. So picture this collision. On one side, you have the creation of new Bitcoin slowing to a trickle, a programmed scarcity that can't be changed. On the other side, you have the most powerful financial entities on the planet turning on a fire hose of demand. Demand now fully sanctioned by the government. What happens when an unstoppable force of institutional demand meets the immovable object of programmed shrinking supply? The price is just the outcome. It's the digital readout of this epic battle between institutional appetite and algorithmic scarcity. This is why you see data driven analysts from major firms projecting price targets of $170,000 or even over $200,000. These aren't wild guesses. They are calculations based on the collision course we're on. They are modeling the brutal economics of what happens when the entire financial establishment decides it wants a piece of an asset designed to be the scarcest thing in the world. For more than a decade, we were told a story. It was a story about a people's currency, a grassroots movement, a rebellion against the old guard. It was a story where the price was driven by the whims of millions of individual dreamers. That story is now a myth. The truth is far more stark and far more consequential. Bitcoin hasn't overthrown the financial establishment. It has been absorbed by it. The price is no longer moved by retail hype. It is commanded by the cold, calculated, and overwhelming force of institutional capital. The direction is no longer set by cypherpunks. It's being dictated by regulators in Washington, D.C., who have built a framework not to protect you, but to empower the powerful. The real drivers are BlackRock's ETF engine, relentlessly consuming supply. The real drivers are corporate treasurers, locking Bitcoin away for a generation. And the real drivers are the politicians who finally realized it's more profitable to join the revolution than to fight it. This is no longer a story of pure decentralization. It is a story of consolidation and control. This isn't a judgment on whether that is good or bad. It is simply the truth. Recognizing this reality is the first and most critical step to understanding what Bitcoin has become and where it's going next. The retail trader may still be at the party, but they are no longer choosing the music. They aren't just participating in the Bitcoin market anymore. They are the market. And the sooner you understand that, the sooner you'll understand where this is all really going.